Before we do that, I want you to pull up this handout, which is an example of a private equity rollover structure, which comes from Tim's firm he works with, and I adapted it to this particular transaction. But we were working on a transaction last fall with with Baker Tilly, and the private equity firm insisted that we structure it this way, and we represented an S corporation like ABC Corp. Okay. Why they do it this way, I'll explain in a second. But here's how the transaction works. So if you go to page 3, it starts with the owners of ABC owning their stock, and it's an S corp. So we'll call it the XYZ family. And then go to page 4. We reorganize the company. It's known as an F reorganization. It's 368A1F of the Internal Revenue Code. And that code section allows us to do this structure where XYZ family, or Helen, takes her shares and she contributes it to a new S corporation, which actually may be either an S corp or an LLC taxed as an S corp, and it elects S status. And then ABC, which was the operating company, elects to be treated as a qualified subchapter S subsidiary. This is all getting ready for the acquisition. This is what the private equity firm wants. This is the structure that they will dictate. Why do they do this? Again, I'll explain in a second. So you flip the page. Step 2. ABC, which has been a corporation all along, converts. Under Virginia law, Delaware law, very simply converts into a limited liability company. That's what the triangle indicates. Because it's a limited liability company, and it's wholly owned by the new S corporation, ABC Newco, it's now able to be treated as a disregarded entity for tax purposes. It's still a limited liability entity, but it's disregarded for income tax purposes. Flip the page. We may actually put a JV Newco in between ABC Newco and ABC. Again, these are all tax-free transactions. Why are we creating all this complexity, my clients ask? Because the buyer, which is a private equity fund, wants it structured this way so they have flexibility in the future. And we're not going to pay 100% in cash for your stock. We're going to pay 80% in cash for your stock. And we're going to leave you with an ongoing ownership interest in the entity of 20%. It's known as rollover equity. That's page 7. So the PE firm, the private equity firm, which may be a limited liability company or a limited partnership, puts money into JV Newco. JV Newco takes the cash and distributes it out to ABC Newco, which may in fact distribute it out to the shareholders. Why do they do this? So that they can have you keep some skin in the game after the transaction. And this may be not the founder, it may be some of the key employees, the management team. It may be a combination of the two. It also avoids taxation on keeping that 20%. So you don't have to pay income tax on keeping this 20% interest. You only have to pay income tax on the distribution of the 80%. And that's under the disguised sale rules, under the partnership rules. Again, it's all been vetted. The IRS has approved of this transaction, and it's very commonplace. And so the PE firm, which is a combination of individuals, institutions, corporations, other investors, wants this structure, and they get to treat it as an asset purchase, because even though they're acquiring the essentially through JV Newco, the shares or the business of ABC, they can treat it as an asset purchase because ABC is disregarded, and so they're using the cash to buy the assets effectively of ABC, and they get a write-up of the goodwill and all the other assets in the transaction. So some of it will be ordinary income, some of it will be taxed as long-term capital gain in this transaction. This is a valuable chart because you want to keep this for any client in the future that is going to do a deal with a private equity firm. Because invariably, this is the structure that they're going to use. So back to the transaction and the purchase agreement. There's so many different permutations of transactions, right? So we may get cash at closing. We may get cash and a promise to pay in the future for some of the purchase price, known as a holdback note, promissory note. We may get cash, but from that cash may be subtracted amounts set aside into an escrow to protect the buyer from liability that they may incur as a result of the seller's breach of their reps and warranties in the transaction, an indemnity escrow. There may be an adjustment to the purchase price that occurs after the closing when everybody trues up the numbers. Because the buyer is going to want to see a certain amount of working capital in the company when they buy it, or a certain amount of cash left in the company when they buy it. And if it's not there, after closing, they want to adjust the purchase price up or down. Well, in this deal that we closed in March that got the premium, where we went back to the other prospective buyer, we just had a purchase price adjustment. It was 6 months after we finalized it, 6 months after the transaction. Usually it's a little shorter period. And the sellers got $800,000 extra. They were very happy, but that's probably because the internal people that were at the seller really did a crappy job of reconciling the books and records, as opposed to having a windfall or anything like that. Earnouts. We're going to talk about earnouts in detail before we leave today. And then the flow of funds. So the purchase price section 1 of the agreement, is usually fairly detailed, fairly long, and we're making sure that we're clearly indicating how the money is going to flow at closing and after closing. What's an earnout? When a buyer comes in, they do their due diligence, and the seller says, I want $25 million for my business. And the buyer says, I can see the $20 million, but there's $5 million there that's a little squishy to me. And some of these contracts aren't really, you say they're real, I doubt you. Let's put an earnout in place so that if you do what you say you were going to do, said you were going to do, we'll pay it out to you. In fact, if you do better, we might even give you a premium on that. But that's what an earnout is. It's deferring a piece of the purchase price into the future. And let's say it's on achieving a certain level of revenue in the coming years. And you say, look at my backlog of contracts. I'm definitely going to hit this revenue target. Well, they could cancel the contract. Your relationship with the customer is not so good. Let's put this in an earnout. How does the seller retain control over the ability to achieve that earnout? And that's where the negotiations come in. So in one transaction I had many years ago, probably 12 years ago now, we had it was a seller's market. The seller said, I don't want an earnout. The buyer said, you have to have an earnout. We said, fine, we'll have an earnout, but my seller is in control during the earnout period. You can't remove that person from employment unless they do something extremely egregious, fraud, misappropriation of assets, usurpation of corporate opportunity. Tim hates this because he's been on the other side of this transaction. I've actually negotiated against him on this. But what did they do? Or just incompetence, right? What you want to do as the seller is try to protect the seller's right to earn that earnout. Because what happens in this integration process after the acquisition is that the buyer may change their plan. They may say, well, all along I was kind of thinking that you would be head of this division, and we'll just keep your division intact. Don't worry about it. Everything will be fine. Trust me. That doesn't always work. Right, Ed? Yeah. So what we want to do is, there's a negotiation that, and again, depending on the leverage, depending on the information, depending on the background, you may have the ability as the seller to negotiate some protection in this. And we did that in this recent transaction. We got some protection. We didn't get everything we wanted, but again, it's a compromise. And as long as you have certain protections to protect the ability to earn the earnout, if it's revenue-based. Profit-based is a lot harder because the buyer wants to allocate some of the overhead that they're incurring on your behalf to you as the seller, which is going to reduce your profit and your ability perhaps to earn the earnout. It's reasonable for the buyer to be able to do that. Can we agree on what they're going to allocate or cap it so that above a certain level, there's no more than a reasonable allocation of overhead or expenses or SG&A, selling general and administrative expenses? So allocating control of who has the ability to earn the earnout is really a function of leverage in the transaction. If the seller just wants to get the hell out and says, I got what I wanted, which I've had transactions occur where they got their base purchase price and there was never really any anticipation of getting the earnout, and they didn't really care, okay, that's fine. But there are a lot of people who do care about getting that upside, and so we want to protect that upside to make sure that they get what they were expecting as part of the transaction.